I just bought my first property and I haven't applied cost segregation before. Can you explain to me exactly what cost segregation is? Well, congratulations on buying your first property. Did you know you might be sitting on a huge tax saving opportunity? Let's talk about cost segregation and why it's a game changer for real estate investors. So what exactly is cost segregation? How can it benefit you? Cost seg is a fancy term for breaking down the cost of your property into different parts for tax purposes. Normally, when you buy a property, you can depreciate it over 27 and a half years if it's residential, or 39 years if it's commercial. Depreciation means you get to deduct a portion of the property's cost every year on your taxes. But here's the cool part. Not all parts of your property wear out at the same pace. For example, things like carpets, appliances, landscaping, they don't last 27 and a half years. They might only last 5, 7, or 15 years. Cost segregation is a detailed analysis that identifies and separates these faster depreciating items so you can write them off sooner, which means bigger tax savings up front. I think of it like this. Instead of waiting 27 years to eat a giant cake one slice at a time, cost segregation lets you enjoy some of the best pieces much sooner. For example, if your property costs $1 million, a cost segregation study might uncover $200,000 worth of items that can be written off in the first few years. If you have never done a cost seg study before, don't worry, it's not too late. Even if you have already started depreciating your property, you can still do a catch-up adjustment, so reach out and we'll help you maximize your tax benefits.
Timing is everything. So when is the right time to do a cost segregation study? Let's break it down. The best time to conduct a cost segregation study is as soon as possible after purchasing or constructing a property. This allows you to immediately apply the accelerated depreciation to your current tax year and start enjoying the cash flow benefits right away. However, if you're already own the property for a while, it's still not too late. You can do a study, use Form 3115 from the IRS. It's essentially a catch-up of missed depreciation without needing to amend prior tax returns. This flexibility makes cost segregation valuable at almost any stage of property ownership. But the earlier you do it, the more years of tax savings you'll have to leverage. If you're ready to maximize your tax savings, let's conduct a benefit analysis to see what a cost segregation study can do for you. Not all buildings are created equal when it comes to cost segregation. So which types of properties yield the biggest tax benefits? Let's dive in. Buildings with a lot of personal property or specialized components tend to yield the most benefit from cost segregation. These types of properties include apartment buildings and residential rentals. With numerous short-term life assets like appliances, flooring, and cabinetry, these properties often see significant reclassification opportunities. Hotels and resorts, items like furniture, fixtures, decorative elements can result in substantial accelerated depreciation. Retail and restaurants. These properties have specialized lighting, signage, and interior finishes that often are eligible for shorter depreciation periods. Warehouses and manufacturing facilities, machinery, equipment, specialized building improvements often fall into shorter class lives, providing faster tax benefits. Medical offices. With unique systems and fixtures such as X-ray machines or specialized plumbing, HVAC, and electrical, these buildings also perform exceptionally well in a cost segregation study. Additionally, certain properties that are known for having dramatically higher reclassification percentages, making them highly sought after for investors. These include mobile home parks. The infrastructure there, such as the utilities, the roads, often qualify for shorter class lives. Car washes. With heavy equipment and specialized systems, a large portion of that can be reclassified as well. Gas stations, we get this question a lot. Tanks, pumps, specialized lighting, the canopy often qualifies for significant acceleration and bonus depreciation. Self-storage facilities, with minimal structural components, there's still significant site improvements. These properties are among the top performers for cost segregation. Curious about how much your building can benefit from a cost segregation study? Well, let's start with a benefit analysis to uncover your potential savings.
Selling your property after claiming depreciation might sound daunting, but understanding how recapture works can help you plan ahead. When you sell a property, the IRS requires you to recapture any depreciation that you've taken over the years. This doesn't mean paying it all back, but rather paying tax on the portion of your gains attributed to depreciation. Here's how it works. Depreciation you claimed is taxed as depreciation recapture income, typically at a maximum federal rate of 25%. Any remaining profit beyond the depreciated value is taxed as capital gains, which generally has lower rates. The good news, property tax planning, things like 1031 exchange, other factors like buying a property in the same tax year, applying cost segregation with bonus depreciation, these are all strategies that can help defer this tax burden and continue to push that down the line. If you've ever wondered whether to use bonus depreciation or Section 179 to supercharge your tax savings, understanding their differences is key, so let's break it down. Both depreciation and Section 179 are powerful tools that allow you to write off more of your asset purchases in the early years, but they operate a bit differently. So first, eligibility and application. Bonus depreciation applies automatically to most new and used qualifying business assets with a recovery period of 20 years or less. You don't have to specifically elect it, but you can opt out of it if you wish. Section 179 requires an affirmative election on your tax return. It's more flexible. You can pick and choose which assets to expense, giving you much more control. The second difference is annual limits. Bonus depreciation has no annual dollar limit. If you buy $1 million or $10 million worth of qualifying property, you can claim the relevant percentage of bonus depreciation in the first year, subject to the current phase-out rates. Section 179 has an annual limit that adjusts periodically for inflation. Once you hit that cap, you can't expense more under Section 179. There are also phase-outs if you buy more than a certain dollar amount of property each year. Number 3 is income requirements. Bonus depreciation has no limit by business income. Even if you show a loss, you can still claim bonus depreciation to potentially create or increase that loss. For Section 179, you cannot create or increase a taxable loss. Your Section 179 deduction is limited by your taxable income. If you don't have enough income, you may not use the full deduction this year, though you can carry forward the remainder. Number 4, state conformity. Bonus depreciation, some states don't conform to federal rules, meaning you may have to adjust your deductions at the state level. Examples, California, New York, New Jersey, they do not comply with the bonus depreciation rules. Section 179, most states tend to follow federal Section 179 rules, but not all do. State conformity still varies. Which one should you use? The best choice often depends on your specific situation. Section 179 gives you flexibility and control, while bonus depreciation can create large immediate deductions without many restrictions. Many businesses use both in tandem. Section 179 for specific asset choices, and then bonus for the rest. If you're not sure how to combine bonus depreciation and Section 179 for maximizing your tax savings, Engineered Tax Services is not a tax compliance firm. We do recommend discussing this with your CPA. Determining your property's land value is crucial, and there's a right way to do it according to the IRS guidelines. I want to break it down. According to the IRS Cost Segregation Audit Technique Guide, land cannot be depreciated, and so accurately identifying its share of the total purchase price is essential. The IRS recommends using a reasonable and consistently applied method to allocate your total cost basis between land and improvements. For example, relying on arbitrary percentages like a flat 10 or 20% allocation is highly discouraged, as it may not reflect your property's actual proportions. At Engineered Tax Services, we really look at the most reliable approach, which is the property tax ratio. We review the official property tax records, which often distinguish between land and improvement values. By using the same ratio from your tax card and applying it to your total purchase price, we arrive at a figure the IRS views as more defendable and aligned with local assessments. This method helps ensure that your depreciation calculations are solidly supported. Alternative options, if the tax card seems inappropriately skewed, might be to look for an appraisal and determine if the appraised amount is reflecting a different land for value, or alternatively, getting some type of a competitive market analysis or comparables from your real estate agent. If you're ready to get an accurate, defendable land value, let's walk through your options, and we're happy to estimate what the tax card ratios are.
Ready to embark on a cost segregation study, but unsure what the journey looks like or the price tag involved? Let's walk through our detailed, client-focused process. Our process starts with a complementary cost segregation benefit analysis, providing you with an estimated tax benefit and a fixed fee quote for each property. This initial step ensures full transparency about both potential savings and costs before you commit. Next, we encourage a collaborative discussion with you and your CPA and your finance team. During this conversation, we'll dive deeper into how you can actually utilize the estimated benefits, discuss any potential limitations, and outline strategies to make the most of your accelerated deductions. Once everyone's on the same page, we'll request a signed engagement letter and a retainer payment to get started. After that, we'll begin scheduling your project right away. Then, information gathering. We'll send a request for documents, including property details, cost, placed in service dates, and land values. We also welcome any available documents like inspection, appraisals, drawings, cost breakdowns, site plans, or other cost documents that you might have. These materials really help us leave no stone unturned. Then we do a site visit. Within the first few days, we'll schedule a site visit to inspect the property. This hands-on evaluation ensures that our engineering team captures every building component that can be accelerated for depreciation. Then we do the engineering analysis. After the site visit, our engineering team reconstructs the detail of your property. They classify and allocate costs accurately, making sure nothing is missed. Then it's the draft results and review stage. Once our internal analysis is complete, we'll share the draft findings with you and your CPA team, if you like, for confirmation. After incorporating any feedback, we'll deliver a final, comprehensive report. With this in hand, you're ready to apply the tax benefits into your tax return, reducing estimated tax payments or optimizing your next tax return. Cost and value. Our fees are highly competitive, yet we maintain the same level of quality and thoroughness than the Big Four. Also, unlike some other providers who use a placeholder percentages for land value, we verify actual land values from the property tax records or your appraisal to ensure realistic, conservative estimates. This approach ensures that no unpleasant surprises will be had, only reliable results. Are you ready to start the journey towards accelerated deductions, bonus depreciation, and enhanced cash flow? Let's begin with your complementary cost segregation benefit analysis and see how cost segregation can transform your tax strategy. Did you ever wonder if your company's innovations could cut down on your tax bill? Let's unpack the research and development, or R&D, tax credit and see what it means for you. The R&D tax credit, also known as Research and Experimentation Credit, is a federal incentive under Revenue Code Section 41 designed to reward businesses that invest in developing or improving products, processes, techniques, formulas, or software. According to the IRS, the credit aims to encourage U.S.-based innovation and jobs, reducing the after-tax cost of qualified research activities. Eligible activities must satisfy the four-part test outlined in IRS guidance. Permitted purpose. This research must be intended to improve a product, a process, formula, software, or technique. It must be technological in nature. This research must rely on principles of the hard sciences, such as engineering, computer science, physical or biological sciences. Elimination of uncertainty. The work must aim to discover information that eliminates technical uncertainty regarding the capabilities, methods, or design of what you're developing or improving. And then the process of experimentation. The activities must involve a process of evaluating alternatives, such as modeling, simulation, or systematic trial and error. When your activities meet these criteria, the R&D tax credit can help lower your tax liability, freeing up capital to invest in even more innovation. Are you ready to see if your innovation qualifies? Let's explore your projects and find out how to unlock these valuable credits.
What defines a quality cost segregation report according to the IRS's audit technique guidelines? If you're considering a cost segregation study, you might be wondering what the IRS expects to see. So let's break down the hallmarks of a quality study that meets their standards. The The IRS provides detailed guidance on what makes a cost segregation study credible and reliable in their audit technique guide. A quality cost segregation study typically includes qualified preparers. The study should be prepared by knowledgeable professionals, engineers, CPAs, or cost segregation specialists who understand construction, tax law, and depreciation rules. Demonstrating relevant expertise, credentials, and experience is key. The second method is clear and detailed methodology. A quality study explains how each component of the property was identified, classified, and valued. So it should provide a step-by-step narrative showing how costs were allocated into appropriate asset classes, for example, 5-year, 7-year, 15-year property, rather than jumping everything into 27.5 or 39-year schedules. We're also looking for comprehensive documentation. The report should include blueprints, including construction documents, architectural plans, and any other tangible evidence supporting those allocations. These documents create a transparent audit trail, making it easy to verify the study's conclusions. We also look for citations to legal authority. So a strong cost segregation, let's start at 4 again. Number 4, citations to legal authority. A strong cost segregation study doesn't just rely on industry practice. It references authoritative guidance, including IRS rulings, Treasury regulations, court cases, and other official directives. Linking each classification to established tax law provides a solid legal foundation. Number 5, consistent and logical allocation methods. The IRS looks for rational, justifiable techniques for assigning costs. The study should show why certain assets qualify for shorter depreciation periods, not simply make unsupported claims. Consistency across similar properties and a logical basis for allocations help ensure credibility. Number 6, the reconciliation of costs. A quality study reconciles total project costs to the final allocations. This means that you can trace every dollar from the original cost basis through to its assigned category, leaving no unexplained amounts or gaps. And by following these guidelines, a qualified preparers, transparent methods, robust documentation, legal support, and a logical cost allocation framework, you'll create a cost segregation study that not only accelerates your tax benefits, but it also stands up confidently under IRS scrutiny. Ready to ensure your cost seg study passes the muster with the IRS? Let's collaborate and produce a top-tier report that leaves no room for doubt. Are there different types of cost segregation studies? For example, engineering, limited scope, statistical sampling, square foot allocations. Not all cost segregation studies are created equal. Some dive deep into the details, while others take a more high-level approach. Let's explore the different types available and what sets them apart. Cost segregation studies generally fall into a few categories, each differing in depth, methodology, and the level of precision. First, a full engineering-based study. This is considered the gold standard. A team of qualified professionals, often engineers, with tax expertise, examines the property in detail. They review blueprints, invoices, and construction documents, and may conduct a site visit. The result is a highly accurate allocation, well supported by documentation, which aligns closely with IRS guidelines. Engineering-based studies are the most time-intensive, but typically yield the most robust and defensible results. The second type is a limited scope, or an abbreviated study, sometimes referred to as a cost seg light. This approach, these studies may rely on these less detailed documentation or limited sampling of the property's components. While faster and cheaper than a full engineering study, they might not uncover all potential tax savings that can be harder to defend if audited, as they don't offer such a thorough breakdown. The third method is statistical sampling, or modeling. In some cases, practitioners will use statistical or modeling techniques to estimate allocations without examining every component. For example, they might review a sample of units in a multifamily property, like an apartment complex, and extrapolate the findings to the entire building. While this can reduce the time and cost, it may introduce some margin of error. It does require proper sampling techniques to remain credible. Number 4 is a square foot or rule of thumb allocation. These methods are standardized benchmarks, like a cost per square foot. Based on property type, region, or industry averages, they are the quickest and the least expensive approach, but also the least precise. So without a detailed component breakdown, these methods often leave tax savings on the table, and they can be less defensible in an audit. The best type of study depends on factors like your property size, the complexity, and your tolerance for audit risk. Large, complex, or unique properties often warrant a full engineering-based study for maximum detail and credibility. Smaller or simpler investments might justify a limited or a sampling-based approach, though this can mean foregoing some tax benefits. Engineered Tax Services is a licensed engineering firm. We offer the most detailed and defensible study on the market. It's important to understand what you're getting when you are engaging a provider because pricing doesn't always dictate the end result. Our studies guarantee the highest benefit possible for your property. Which type of cost segregation study fits your property and your budget? Well, let's discuss your options and find the right balance between thoroughness, cost, and potential tax savings. What is the best size property to do a cost segregation study on? Well, ever wonder if cost segregation is worth it for your property? Let's figure out if your investment's the right size for a cost segregation study. Cost segregation works best for properties with a value of maybe $500,000 or so, though sometimes it can make sense for smaller properties depending on the situation. The reason is simple. The larger the property value, the more items we can reclassify for faster depreciation, which leads to bigger tax savings. That said, if you're unsure about your property, we can do an initial analysis to see if it's worth pursuing. Not sure if your property qualifies? Reach out. We can help you decide if a cost segregation study is right for you. How much could you actually save with a cost segregation study? Well, the answer might surprise you. Your tax savings depend on the cost of your property, the type of property, and how much it can be reclassified. On average, about 20 to 30% of a property's value can be reallocated into faster depreciating categories. For example, if you own a $1 million building, a study might identify $200,000 or $300,000 you can deduct upfront. That could translate into tens of thousands of dollars of tax savings right away. Of course, every property is different, so a detailed study will give you the exact numbers. Want a rough idea of what your savings could look like? Let's run a quick estimate for your property. You're ready to save on taxes, but how long does a cost segregation study actually take? Well, let's break it down. A typical cost segregation study takes about 30 to 60 days from start to finish. The timeline depends on the complexity of your property and how quickly we can gather the necessary documents like blueprints or invoices. The great thing is, once the study is complete, you can immediately apply the findings to your tax return and start enjoying those savings. Need the savings sooner? Let us know, and we'll help speed up the process. If you accelerate depreciation with cost segregation, will you run out of depreciation deductions later? Well, let's set the record straight. Cost segregation doesn't mean that you lose all of your depreciation. It just shifts more of it to the earlier years of owning the property. You're still getting the same total depreciation over time, but instead of waiting decades to see the benefits, you're taking advantage of a portion of it sooner. And remember, the upfront tax savings can free up cash to reinvest, which can grow your portfolio faster. Want to see how this plays out for your property? Let's dive into the numbers together. If you're renting out part of your home, you might be wondering, can cost segregation work for just the rental portion? Well, let's find out. The answer is yes. You can absolutely use cost segregation on the rental portion of your primary residence. The key is determining what percentage of your home is being rented. So for example, if 30% of your home is used as a rental, then 30% of the property's value could be analyzed in a cost segregation study. This allows you to accelerate depreciation on that portion and get tax savings sooner, all while still living in your home. So if you're renting part of your home or all of it, let us help you unlock those tax benefits. If you're renting out part of your home, you might be wondering, can cost segregation work for just the rental portion? Well, let's find out. The answer is yes. You can absolutely use cost segregation on the rental portion of your primary residence. The key is determining what percentage of your home is being rented. For example, if 30% of your home is used as a rental, then 30% of the property's value could be analyzed in a cost segregation study. This allows you to accelerate depreciation on that portion and get tax savings sooner, all while still living in your home. If you're renting part of your home, let us help you unlock those tax benefits.
Are you curious about how much you'll save with a cost segregation study? Well, let's break it down and you'll find out. Your potential savings depends on the property's cost, type, and how much can be reclassified for faster depreciation. We'll start by estimating what percentage of the property qualifies. Typically 20 to 30%, for example. If your building costs $1 million, for easy math, you might be able to deduct $200,000, $300,000 up front. I think about front-loading that depreciation rather than spreading it out over 27 and a half or 39 years. But when we do an actual cost segregation, a detailed engineering-based study, then we'll get the specifics. Want to see how your property will perform? Get us that information: address, description, purchase date, purchase price. We'll do a professional cost segregation study, benefit analysis, and engagement study for maximum results. Not sure if your property qualifies for cost segregation? Here's the good news. It works for a wide range of properties. Most income-producing properties and those used in business are eligible for cost segregation. This includes residential rentals, commercial buildings like offices, warehouses, retail spaces, and even specialized properties like storage units, hotels, gas stations, car washes, and oil changes. If you own a property that generates income, chances are it qualifies. The only exceptions are raw land and property fully used for personal uses. Still unsure if your property qualifies? Well, let's chat. We'll help you figure it out and get it maximized. If you didn't do a cost segregation study when you bought the property, is it too late? The answer might surprise you. It's not too late. Even if you bought the property years ago, you can still do a cost segregation study and catch up the missed depreciation. This process, called a look-back study, lets you apply the accelerated deductions to your current tax return without amending prior years. It's a great way to unlock savings you might have missed out on. If you've owned the property for years, don't worry, you can still benefit from a cost segregation study. Contact us and we'll help you find out. Are you worried you can't do a cost segregation study because you don't have the original architectural plans or drawings? Don't sweat it. Here's how we're going to handle that. Yes, we can still do a cost segregation study even without the architectural plans or the building drawings. Our engineers use alternative methods which are approved by the IRS. We use detailed site inspections, we use property photos, and the cost estimates in our engineering software to analyze and break down the property into its detailed components. While having plans makes the process much smoother, it's not a deal breaker and it's not required. So you can still access all those juicy tax benefits. Don't delay. Reach out now. We'll take care of it, we'll handle it for you, and we'll show you how it's done. If you're thinking about cost segregation, you might wonder, does someone actually need to visit the property? Let's talk about what's involved. In many cases, yes, a site visit is ideal and the most important part of a cost segregation study process. It allows our engineers to thoroughly inspect the property and document all the components that qualified for accelerated depreciation. This involves everything from structural components to things like flooring, lighting, landscaping, everything inside the building, everything around the outside of the building as well. The more accurate the information we collect, the greater the potential tax benefits for you and the more information that we have. That said, simpler properties or situations where a site visit isn't feasible, maybe it's a sensitive situation or multiple tenants in a property, we can sometimes use high-quality photos, digital records, and other documentation instead. But a site visit usually gives the most comprehensive results and ensures compliance with IRS guidelines, especially for larger, more complex properties. If you're unsure whether a site visit is needed for your property, let's talk, and we'll help determine the best approach for your situation. Timing is everything, so when is the right time to do a cost segregation study? Let's break it down. The best time to conduct a cost segregation study is as soon as possible after purchasing or constructing a property. This allows you to immediately apply the accelerated depreciation to your current tax year and start enjoying the cash flow benefits right away. However, if you already own the property for a while, it's still not too late. You can do a study, use Form 3115 from the IRS. It's essentially a catch-up of missed depreciation without needing to amend prior tax returns. This flexibility makes cost segregation valuable at almost any stage of property ownership. But the earlier you do it, the more years of tax savings you'll have to leverage. If you're ready to maximize your tax savings, let's conduct a benefit analysis to see what a cost segregation study can do for you. If you're considering a cost segregation study after already filing taxes, you might wonder, should you amend your tax return or use Form 3115? Let's start that one over. That was too choppy. If you're considering a cost segregation study after already filing taxes, you might wonder, should you amend your tax return or use Form 3115? Let's explore your options. Amending your tax return isn't typically necessary when it comes to cost segregation. Instead, the IRS allows you to use Form 3115. It's also called an automatic change of accounting. This form lets you claim any missed depreciation from prior years in a single adjustment on your current tax return without having to go back and redo past filings. The big advantage here of using Form 3115 is that it's simpler, faster, and avoids the hassle of amending multiple years' worth of returns. It's especially useful if you've owned the property for a while and want to catch up and grab those tax benefits you've missed. On the other hand, amending your tax return might actually be necessary in cases such as if there was errors related to depreciation. Not sure which option is right for you? That's our job. Let us review it. We'll help you make the best decision for maximizing your tax savings. If you've made improvements to your property, you might wonder, how do those improvements fit into the depreciation timeline? Let's break it down by class life. When you improve a property, each component of the improvement is assigned a specific class life, which determines how quickly it can be depreciated. For example, 5-year class life. This includes items like carpeting, appliances, or decorative finishes, things that tend to wear out faster. Then there's 7-year class life. These are specialty items like office furniture or certain types of equipment fall into this category. 15-year class life, think of the outside of the building. Exterior improvements such as parking lots, sidewalks, landscaping are typically depreciated over 15 years. 27.5-year or 39-year class life, structural components such as walls, roofs, HVAC systems are depreciated over the longer lifespans for residential and commercial properties. During your cost segregation study, we'll analyze each improvement to place it into the correct class life by moving eligible items into shorter class lives. You can significantly accelerate your tax savings. Want to know how we can increase the tax write-offs? Let's prepare a benefit analysis and we'll find out. So you've completed your cost segregation study. So who handles the Form 3115? Let's clarify the process. At ETS Engineered Tax Services, we specialize in providing the engineering and tax data for your cost segregation study, including a detailed analysis of your property and its depreciation potential. While we don't typically file the Form 3115 on your behalf, we do provide all the necessary documentation to your CPA, making the process as smooth as possible. Your CPA is typically the one to file the Form 3115, as they handle your tax returns and can ensure everything is properly aligned with your overall tax strategy. If your CPA needs guidance, our team is happy to collaborate with them to answer the questions and provide additional support. Together, we can make sure you're maximizing all your tax benefits without missing a beat. Have questions about Form 3115 or need help with collaborating with your CPA? Let's work together to make the process seamless.
If you're developing a condo property and plan to sell the units, you might wonder, does cost segregation still apply? Here's the answer. Cost segregation is generally designed for properties that you hold and use as income-producing assets, not those that you build with the intent to sell. If you're selling the condo units, you're typically classified as a real estate dealer, which means the units are treated as inventory rather than depreciable assets. However, if you decide to retain some units as rentals or for long-term investments, those specific units could qualify for cost segregation. Once those are placed in service as income-generating properties, you can apply accelerated depreciation to maximize your tax benefits. For developers, there may also be opportunities to capitalize certain costs during construction that can impact your tax strategy. So it's worth reviewing your plans with a tax advisor to explore all of those options. Let's discuss your project and see how we can help you optimize your tax benefits for both development and long-term investment strategies. If you're considering a cost segregation study, you might be wondering, does Engineered Tax Services work with local inspectors and how does that affect the cost? Well, Let's redo that. Quashed.
Quashed.
How about factor quashed?
3.
If you're considering a cost segregation study, you might be wondering, does engineered tax services work with local inspectors, and how does that affect the cost? Yes, ETS has inspectors and engineers nationwide, which means we can often send someone local to your property. By using professionals in your area, we help reduce travel-related expenses, keeping the cost of your study very competitive. As for overall pricing, our services are designed to deliver significant value. The tax savings you gain through accelerated depreciation typically far outweigh the cost of the study itself. Our benefit analysis will show you exactly how much you stand to save so you can make an informed decision. With ETS, you're not just paying for a report. You're getting a comprehensive service that maximizes your tax benefits while adhering to the strictest IRS guidelines. Have concerns about location or cost? Let's discuss your property and we'll create a plan that works for you. Thinking about turning your home into a rental property? Here's what happens from a tax perspective and how cost segregation might come into play. When you convert your primary residence into a rental property, the tax rules change. The property is now classified as an income generating asset, which means you can begin depreciating it for tax purposes. The depreciation is calculated based on the lesser of your adjusted basis, which is typically your purchase price plus improvements, or it's the fair market value of the property at the time of the conversion. Again, whichever is the lesser of the two. This is also a great time to consider a cost segregation study. By analyzing the components of your home, we can identify assets like the flooring, appliances, and landscaping that qualify for shorter depreciation periods. This can help you offset rental income with accelerated deductions, boosting your cash flow as a landlord. Converting your home into a rental? Let us help you make the most of the tax benefits available to you. Wondering when you can start depreciating your property? The key lies in the IRS term placed in service. Let's break down what it means and why timing matters. The IRS defines placed in service as the date when a property is ready and available for its intended use, whether that's being rented out or used in a business. For rental properties, this means the property must be in rentable condition and available to tenants, even if it's not yet generating income. For example, if renovations were completed on June 15th and the property is ready for occupancy, it's considered placed in service as of that date, even if the first tenant doesn't move in until July. The distinction is especially important when it comes to short-term versus long-term rentals. Short-term rentals, these often qualify as active income rather than passive, depending on how involved you are in managing that property. If you materially participate, meaning you meet certain thresholds for hours spent managing the property, you may offset this income with deductions like depreciation. For long-term rentals, typically passive income unless you qualify as a real estate professional or you meet material participation requirements. Material participation is crucial for maximizing tax benefits, especially for short-term rentals. You can achieve it by meeting one of several criteria, such as working 100 hours on the property and being the most involved individual, or dedicating 750 hours per year to your rental activities. To meet those thresholds, it's helpful to have rental properties up and running with at least a few tenants prior to year end. This ensures you can count time spent managing those properties towards your material participation goals. Do you need help navigating those depreciation rules or maximizing your participation hours? Let's start with a benefit analysis and we can see how we can help support your goals. Yeah.
Closing again. 3.
Need help navigating depreciation rules or maximizing your participation hours? Let's start with a benefit analysis and see how we can help support your goals. Soft costs are indirect expenses related to acquiring, constructing, or improving a property. Examples include architectural fees, engineering fees, permits, and legal expenses. In a cost segregation study, those costs are allocated proportionally across the various asset classifications we identify. For instance, if part of the building qualifies for 5-year depreciation, like carpeting, a portion of the soft cost tied to that asset is also assigned to the 5-year class life. This ensures that you maximize your accelerated depreciation, not just for the physical assets, but also for the associated soft costs. Properly allocating soft costs requires careful analysis, which is why it's so important to work with a knowledgeable team like Engineered Tax Services. If you have questions about how your project's soft costs fit into a cost segregation study, let's explore how they can maximize your tax benefits. Site visits are a key part of cost segregation. But what happens during a site visit, and how do in-person and virtual site visits differ? Well, we'll break it down. A site visit is when our team inspects your property to identify and document the assets that qualify for accelerated depreciation. This includes looking at things like lighting, flooring, HVAC systems, and land improvements. For in-person site visits, an engineer physically visits your property. Taking detailed measurements and photographs, this option is often ideal for large or complex properties where precision is critical. For virtual site visits, we use this for simpler properties or where logistics make an in-person visit difficult. We can conduct this type of a visit, which involves using high-quality video footage, photographs, and detailed information provided by the property owner or manager. Both options provide reliable results, but in-person visits may offer additional insights for unique or customized properties. If you're not sure which type of site visit is right for you, let's discuss the options and we'll create a plan that's tailored to your needs. If you're hearing about Form 3115 and a 481A adjustment for the first time, it can sound overwhelming, but let's break them down step by step. Form 3115, the application for change in accounting method, is used to notify the IRS when you're changing how you report certain items on your tax return. In the context of cost segregation, it's often used to reclassify assets for accelerated depreciation on properties that you already own. Then, the 481A adjustment ensures that you don't double count or miss any depreciation. It's a one-time adjustment that accounts for the difference between the depreciation you've already taken and then the amount you could have taken if the new method had been used from the start. This adjustment allows you to catch up on missed depreciation in the current tax year without amending prior returns. You'll typically need a Form 3115 and a 481A adjustment when you conduct a cost segregation study on a property that you've owned for several years. Also, when you're changing from a standard depreciation method to an accelerated one. Your CPA or tax advisor will file the Form 3115 with the tax return, and Engineered Tax Services provides all of the documentation to make this process seamless. If you have questions about the Form 3115 or a 481A adjustment, let's ensure that you're maximizing your benefits while staying compliant with the IRS rules. Whether you're building a property or buying an existing one, cost segregation can help. But how does the process differ? We'll break it down. Yes, cost segregation applies to both new construction and the purchase of existing buildings, but the approach is slightly different. For new construction, if you're building from the ground up, we can conduct a cost segregation study as soon as construction is completed. This allows us to analyze architectural plans, construction invoices, and other documents to identify assets that qualify for accelerated depreciation. For existing buildings, when you purchase an existing property, we focus on analyzing the building and its components at the time of purchase. We don't need to know the history of the building's construction. Instead, we look at its current condition and we allocate those costs accordingly. In both cases, the goal is the same: reclassifying eligible assets into shorter depreciation periods to maximize your tax savings. However, with new construction, you may have more documentation available to work with, which can provide additional clarity for the study. Whether you're building or buying, a cost segregation study can unlock substantial tax savings, so let's explore the best approach for your property. You've unlocked significant deductions with cost segregation, but what happens if you can't use them all in the first year? Well, if you can't utilize your full depreciation deduction in the current tax year, don't worry, it's not lost. Any unused deductions actually carry forward indefinitely as a passive activity loss or a net operating loss. These losses can offset passive income in future years, which could come from other rental properties, real estate sales, or even gains from partnerships. Additionally, if you qualify as a real estate professional or meet certain material participation requirements, you may be able to use those losses to offset active income, such as wages or business income, depending on your tax situation. The carry forward provision ensures you can maximize your tax benefits over time, even if your income this year doesn't allow you to take full advantage right away. Let's analyze your tax situation to ensure you're fully leveraging your deductions, whether it's this year or in the future years.
So you've heard cost segregation reduces taxes, but how does it translate into actual tax dollars saved? Here's a simplified breakdown. Cost segregation reduces your taxes by accelerating depreciation deductions into the early years of property ownership instead of spreading out the deductions over 27.5 or 39 years. You can reclassify certain assets into shorter periods, like 5, 7, or 15 years. The net tax benefit depends on your marginal tax rate and the amount of reclassified depreciation. For example, if a cost segregation study reclassifies $500,000 into shorter depreciation schedules, and you're in a 35% tax bracket, your first year savings could be $175,000. This immediate savings improves your cash flow, allowing you to reinvest in additional properties, pay down debt, or maybe grow your portfolio. We provide a benefit analysis before starting the study, so you know exactly what kind of tax savings to expect. Curious about your potential tax savings? We'll reach out to us and we'll help you learn more. Tax depreciation methods can feel like alphabet soup. Straight line, makers, ADS, what do they actually mean? Which one applies to you? Well, let's break it down. Here are three main depreciation methods you'll encounter. First, there's straight line depreciation. This means this method spreads the depreciation of an asset evenly over its useful life. For real estate, that's typically 27.5 years if it's residential or 39 years if it's commercial. The simplest method, but doesn't maximize tax savings in the early years. Makers Modified Accelerated Cost Recovery System. This is the IRS's standard for most assets in the United States. It accelerates depreciation for certain components of a property, allowing larger deductions in the earlier years. Cost segregation uses makers to reclassify assets like flooring, HVAC systems, or land improvements into shorter lives, such as 5 years, 7, or 15 years. ADS, Alternative Depreciation System. ADS uses longer depreciation periods and is required in certain situations, such as properties used for tax-exempt purposes or properties in foreign countries. It's less favorable for maximize immediate tax deductions and doesn't get bonus depreciation, but may be necessary depending on your certain circumstances. Cost segregation focuses on applying makers for accelerated depreciation, maximizing your tax savings while staying compliant with all IRS rules. Still unsure about which method applies to your property? Let's walk through the details and maximize your deductions. Maximizing your tax benefits often depends on your participation level, and short-term rentals have a unique advantage. Let's unpack the rules and opportunities. Let's start with the basics. Passive participation. Most rental activities are passive by default. This means losses such as depreciation can only offset passive income, unless you qualify for certain exemptions. Active participation. If you're actively involved in managing a rental property, meaning approving tenants, handling repairs and maintenance, arranging the insurance, you may deduct up to $25,000 of losses against non-passive income, provided that your modified adjusted gross income is under $150,000. The short-term rental loophole we've all been hearing about. Short-term rentals are a game changer. If the average stay at your property is 7 days or less, the IRS does not classify it as rental activity for tax purposes. Instead, it's treated as active income, even if you don't qualify as a real estate professional. To take full advantage, you need to meet material participation requirements. The good news is, the bar is much lower for short-term rentals. Here's how you can qualify. First, the 100-hour rule. If you spend at least 100 hours managing the property and perform substantially all of the work, meaning no one else, such as the property manager, contributes more time than you do, you meet the material participation threshold. Number 2, multiple properties. If you manage several short-term rentals, you can aggregate the hours across those properties to meet participation requirements. This loophole allows you to offset, I don't love the term loophole, but This loophole allows you to offset active income like wages or business earnings with depreciation and other deductions from your short-term rental. For long-term rental properties outside of the short-term rental loophole, achieving real estate professional status requires this. First, 750 hours per year in real estate-related activities. Second, spending more than 50% of your working hours on real estate. For properties that include an active business, like car washes, gas stations, or self-storage, the classification depends on whether the income is derived primarily from rentals or the business operations. This distinction impacts how depreciation and deductions are applied, offering unique planning opportunities. The short-term rental loophole provides a faster and more accessible way to unlock tax savings, particularly if you're not yet eligible for real estate professional status. Coupled with strategic cost segregation, it's a powerful tool for maximizing cash flow and reducing taxes. Curious about how the short-term rental loophole can work for you? Let's dive into your specific situation and develop a tax strategy that fits your needs. Selling your property after claiming depreciation may sound really daunting, but understanding how recapture works can help you plan ahead. When you sell a property, the IRS requires you to recapture or add back the depreciation you've taken over the years. This doesn't mean paying it all back, but rather paying back tax on the portion of your gains attributed to the depreciation. Here's how it works. Real property depreciation is recaptured at 25%. Personal property recapture, which gets the bonus depreciation, is taxed at ordinary income tax rates, up to 37%. However, your effective tax rate depends on your overall income deductions and tax brackets. Please check this with your CPA. Any remaining profit beyond the depreciable value is taxed at capital gains, which generally has lower rates. The good news, proper tax planning like 1031 exchanges or even buying another property that we can cost segregate can help you defer this tax burden. So what happens if I sell within 5 years? Will I be hit with depreciation recapture? Yes. Depreciation recapture applies no matter how long you own the property. There's no special exemption for selling within 5 years. However, the amount recaptured depends on how much depreciation you've claimed by the time of sale. For example, if you sell within 5 years, personal property items reclassified through cost segregation will likely have depreciated significantly, triggering higher recapture on this portion. Real property depreciates over 27.5 or 39 years, so less recapture is triggered early on. There's other things that we can do to help mitigate depreciation recapture. For example, we can analyze properties that we can write down the valuation, or we can help with an additional cost segregation study on a new purchase property to help offset the gain. So what's the minimum hold period on a real estate investment property? There's no minimum hold period to avoid depreciation recapture. Even if you sell after 1 year, the IRS will recapture depreciation taken up until that point. However, keeping a property longer allows for more strategic tax planning, such as leveraging the benefits of long-term capital gains rates, maximizing the use of depreciation deductions before selling. Ultimately, your hold period should align with both your investment goals and your real estate tax strategy. So how does recapture work when you sell the property? Here's a scenario. You purchased the building for $1 million. After cost segregation, you claimed $300,000 in depreciation, $100,000 on 5-year personal property, and $200,000 on real property. Then, you sell the property for $1.2 million after 5 years. Congratulations. Here's a step-by-step breakdown. First, calculate the adjusted basis. That's the original purchase price, $1 million, minus depreciation taken, $300,000. Adjusted basis equals $700,000. Then, determine the total gain. Your sales price was $1.2 million, minus the adjusted basis, $700,000, equals a total gain of $500,000. Finally, apply the depreciation recapture rules. For 5 and 15-year personal property, the depreciation taken was $100,000. This is recaptured at ordinary income rates, which are taxed at up to 37%, depending on your personal tax rate. For the real property, which is taxed at 25% rate, depreciation taken was $200,000 and is recaptured at a maximum 25% federal rate. The remaining gain of $200,000, not related to depreciation, which was taxed at long-term capital gains rates, 15% or 20%. So here's the key tip. Planning ahead for these results ensure you're maximizing net proceeds from your sale.
Starting in 2023, bonus depreciation dropped to 80%, and it will decrease by 20% each year until it's gone in 2027. While this change may seem like a loss, cost segregation remains incredibly valuable because of it. Cost segregation identifies components of your property eligible for faster depreciation. It provides tax savings upfront by reclassifying assets into shorter categories like 5, 7, or 15-year property. And even without full bonus depreciation, these accelerated deductions significantly reduce your taxable income. Remember, bonus is just a temporary enhancement. Cost segregation works regardless of bonus percentages. The trigger date really looks at bonus applying based on when the asset was placed in service. It needs to be placed in service by the end of that tax year. So, for 2023, properties must be operational by December 31st, 2023 to claim the 80% bonus deduction. As of right now, currently the end of 2024, we do highly anticipate there will be a new tax bill with extension to 100% bonus depreciation early in 2025. As that changes, we will update our information and notify clients. Wondering if not being a real estate professional will impact your tax savings? Well, let's clarify what it means and how it might affect you. Ultimately, not being a real estate professional doesn't mean that you can't enjoy the significant tax benefits of cost segregation. It just changes how you can use them. As a non-real estate pro, your rental activities are generally classified as passive income. Passive losses, like those generated by depreciation from cost segregation, can only offset other passive income, such as income from other rental properties, limited partnerships, or similar activities. However, you can still carry forward unused passive losses to future years to offset future passive income. The big difference is that real estate professionals can use passive losses to offset active income, such as wages and business profits. If you're not a real estate pro, but you are involved in short-term rentals, the short-term rental loophole could still allow you to offset active income under certain conditions. Ultimately, whether or not you're a real estate pro, can cost segregation or strategic tax planning unlock major tax savings? It can, just in slightly different ways. Let's talk about your own specific tax situation, and we can look at that between you and your CPA. Not all rental properties are taxed the same, especially when it comes to long-term versus short-term rentals. Here's what you need to know. The key difference between a long-term and a short-term rental lies in the average rental period. Long-term rentals, which are properties rented for an average or more than, long-term rentals, properties rented for an average of more than 7 days, are considered passive activities, which means that losses can only offset passive income unless you qualify as a real estate professional. The short-term rentals, the average rental period is 7 days or less. These are not classified as passive activities for tax purposes. You can then deduct losses against your active income if you meet material participation requirements. So what are the material participation requirements? Well, they differ between short and long-term properties. For short-term rentals, the 100-hour rule. If you work 100 hours or more on the property and no one else works more than you, then you likely qualify. The 750-hour rule for long-term rentals is specifically for long-term rentals where you need to meet the 750-hour rule and more than 50% of your time or professional activities to qualify as a real estate professional. Short-term rentals offer a unique opportunity to unlock tax benefits with fewer hours of involvement, making them an attractive strategy for many investors. If you're considering a short-term rental versus a long-term rental and how that works, and if depreciation is right for you in either strategy, please reach out anytime. We're happy to help. If you're aiming to meet real estate professional or material participation standards, it's essential to know which activities count and how to document them. The IRS is specific about the types of activities that qualify. Here are some examples of what does and does not count towards meeting the requirements for material participation. First, qualifying activities. Meeting with contractors, inspectors, or vendors. performing or supervising repairs and maintenance such as landscaping, painting, or plumbing, managing day-to-day operations like tenant issues and lease agreements, preparing properties for rent, including cleaning or staging, scheduling and overseeing property improvements or capital upgrades, traveling to and inspecting the property for management purposes, communicating directly with tenants or potential renters, including emails, calls, and text messages. Non-qualified activities. This is time spent on education or training, such as seminars or reading books about real estate. Those do not qualify. Investor activities like reviewing financial reports or researching future investments. Other items like bookkeeping, tax preparation, and other purely administrative work unrelated to the day-to-day operations of the rental property. Finally, delegated activities managed entirely by a property manager or a third party. Providing activities during an audit, thank you. Proving activities during an audit, the IRS expects detailed records to verify your claims. Here's what you'll need to have on hand. Number 1, time logs. Maintain a daily or weekly log documenting the date, the time spent, and description of the activities performed. Number 2, receipts and invoices. Attach evidence like receipts for materials purchased, invoices for repairs, or contracts with your vendors. Number 3, emails and communication. Keep copies of your emails or your letters exchanged with your tenants, your contractors, or your agents. Number 4, mileage logs. If you're traveling to and from the property, number 4, mileage logs. If travel to and from the property is included, record the purpose of the trip, the distance traveled, and the date. Number 5, calendars or schedules. If applicable, keep copies of your schedules for appointments, for meetings, or inspections. A key tip, the IRS may scrutinize vague or inflated time estimates, so it's crucial to be specific. Avoid using round numbers, for example, 8 hours every day. Instead, provide realistic and varied entries. For example, 3.5 hours repairing leaky faucets on March 12th. By keeping this type of thorough and accurate documentation, you'll not only meet the requirements, but you also have the evidence to back it up if the IRS questions your participation. Material participation, particularly for individuals who also have other income, can be an audit trigger. So be aware of what qualifies and what doesn't, and make sure you're doing what you need to properly track and document those activities. Active and passive investments are taxed differently. Here's a simple walkthrough of how they're reported and how they interact. First, passive activities, like most rental properties, they're reported on a Schedule E of your tax return. This form lists income and expenses for each property, and then it calculates the net income or loss. Here's how it works. The net losses from one passive property can offset the property's...
Here, 3.
Here's how it works. Net losses from one passive property can offset profits from another. Total passive losses can only offset passive income unless you qualify as a real estate professional or you meet other exceptions. There are grouping rules, and the IRS allows you to group multiple rental activities into a single activity if they form an appropriate economic unit. Grouping can help meet material participation rules and simplify reporting, but it must be done with care to comply with these IRS guidelines. With depreciation and passive gains, depreciation from property A can offset profits from another passive property. However, passive losses cannot offset active income, such as your wages or capital gains from non-passive activities like the sale of stocks. If you're unsure how your property should be grouped or reported, careful planning ensures that you maximize your deductions while staying compliant. When you're looking to apply cost segregation on your property, many of these factors impact the utilization for those deductions. Here at Engineered Tax Services, we're here to help evaluate that and work together with you and your CPA to identify what's in your best interests. If you've heard the rumor that cost segregation is disappearing, let me set the record straight. It's not going anywhere. The misconception likely stems from the phase out of bonus depreciation, which is separate from cost segregation. Bonus depreciation began phasing out in 2023, dropping from 100% to 80%, and then further reductions at 20% per year until it reaches 0% by 2027. Cost segregation, however, isn't tied to bonus. It's a method of reclassifying your property's components into shorter depreciation periods, which accelerate deductions. So whether bonus is 100%, 80%, or 0, cost segregation still provides powerful tax benefits by increasing your cash flow. Think of bonus as an optional turbocharge to the cost segregation strategy. It's not the core engine itself. We highly anticipate we will see an extension to 100% bonus depreciation in early 2025, so stay tuned for that. What if you could front-load years of tax savings into your first year? Well, that's the power of bonus depreciation. Bonus depreciation allows you to deduct a large percentage of certain property costs upfront rather than spreading them over decades. Here's how it works. Use cost segregation to identify assets eligible for shorter recovery periods, 20 years or less ultimately. Apply the current bonus percentage. For example, it's 80% in 2023, 60% in 2024. You apply that bonus depreciation to these assets, claiming that portion as an immediate deduction. Depreciate the remaining value of those assets over their regular schedule. So, for example, if your property has $500,000 worth of 5-year assets, you can deduct $400,000, which is 80%, in 2023. Then the remaining $100,000 is spread over the next or over 5 years in total. For 2024, the same example, $500,000 at 60% bonus, you would deduct $300,000 year one, and the remaining $200,000 is spread over 5 years. It's actually spread over the next subsequent 4 years since you've taken year one in that initial year. Hopefully, we'll have 100% bonus depreciation reinstated for 2025. In that scenario, that $500,000 that we have reclassified is fully deductible in year one. So we're excited about that. We'll keep you posted. Tax law changes can feel like a moving target, but knowing your options can help you stay ahead of the game. If legislation retroactively increases bonus depreciation back to 100%, you have options to claim the additional benefit. Number one, amend your return. You can update your filed tax return to reflect the higher percentage. You can also file a Form 3115 if you prefer not to amend your return. Use this form to adjust your accounting method and capture the extra depreciation in the current year. Staying informed about potential tax law updates ensures that you don't miss out on valuable deductions. We also get asked often if we complete a cost segregation study and depreciation like 2024 is at 60% bonus depreciation and it gets changed retroactively, what do we do? Here at Engineered Tax Services, we will update your report, but it's also a quick change in the tax return that the CPA can make a quick adjustment to.
Are you comparing bids? If one provider's prices or promises seem way too good to be true, let's talk about what that might really mean. If you find a provider offering a dramatically low fee or a wildly higher projected tax benefit, it's worth asking how they arrived at those numbers. Sometimes rock bottom prices come at a cost of quality and thoroughness. On the flip side, sky-high benefit projections might rely on overly simplistic assumptions, like using a generic placeholder for your land value instead of verifying actual values from your property tax card or an appraisal. We pride ourselves in a balanced conservative approach. Our pricing is highly competitive, but not at the expense of the study's rigor. Our analysis aligns with the Big Four standards, yet remains far more affordable. By performing a careful, conservative benefit analysis and then accurately assessing the land values, we ensure the benefits we project are ones you can actually realize. Essentially, we'd rather pleasantly surprise you with real results than disappoint you with overinflated promises. When you compare bids, look beyond the price tag and bottom line number. Consider the methodology, the documentation, the standards, the support behind the scenes with the team, and whether the provider takes the extra additional steps to avoid overestimating benefits. Want to see why our approach to cost segregation stands out from the crowd? Let's review your property and compare options together.